Now solve this question. An entity opens a new factory and receives a government grant of $15,000 in respect of capital equipment costing $100,000. It is depreciating plant at the rate of 20% per annum, straight line method. We have to show the profit and loss statement, and you have to show the statement of profit and loss and statement of financial position extract in respect of the grant in the first year under both the method. So method 1, what will be the depreciation? Let's calculate first. So value of asset is $100,000 and the grant is $15,000. So the cost after grant is $85,000. So depreciation is 20%. So 20% of 85,000 will be $17,000 per year. So this is the depreciation per year. Now in balance sheet, asset will come, no grant will come. Asset will come as total cost of asset 85,000 and accumulated depreciation 17,000. This is the treatment in balance sheet. And profit and loss account, this 17,000 will come as an expense. So in profit and loss, this 17,000 will come as a expense. So depreciation 17,000. Another treatment, as per the other treatment, we have to calculate the excess depreciation. So excess, what is excess depreciation? So if we will not deduct this price, this amount, if we will not deduct this amount, what will be the depreciation? Depreciation will be charged on $100,000 at the rate of 20%. So 20% of $100,000 is $20,000. What is extra depreciation? Extra depreciation is $20,000 less $17,000. So 3,000 is the extra depreciation. Now in balance sheet, asset will come in the asset side with full amount, that is 1 lakh or $100,000, and government grant will come as a deferred credit, that is 15,000. At the end of year, you have to deduct this extra depreciation, so less 3,000 at the end of year. And in profit and loss account, in credit side, we will charge depreciation with 20,000. So depreciation will be 20,000 in credit side. Other type of government assistance may include provision of interest-free loan or guarantees. These should be disclosed in the note to the accounts. Now repayment of grant. In some cases, grant may need to be repaid if the condition of the grant are breached. If there is an obligation to repay the grant and the repayment is probable or certain, then it should be provided for in accordance with the requirement of IAS 37 that we will discuss in chapter 15. If the deferred income method for capital grant has been used in deferred income method, we recognize the asset with full price. Then the remaining grant would be repaid to the government. Remaining grant means the grant that is not yet apportioned or is not yet transferred to the profit and loss account. That will be transferred to the government, that will be paid to the government. Any amount released to profit and loss also need to be reversed depending on the level of repayment required. Better it will be discussed in detail in 37. If the netting off method of capital grant has been used, means if you have deducted the cost of non-current asset from the from the grant that you have received, then the cost of asset must be increased to recognize the full cost of the asset without the grant. The liability will be set up for the grant repayment. So we will set up a liability for the grant repayment. Once you will pay the grant, you write off the liability.